spend too much of our day on social media. But at least you can spend your endless scroll time to discover new things on
Log on.
Good morning, everybody. Welcome back. If you haven't seen it already, take a look. U.S. equity futures are under some pressure at this hour. We've seen a lot of big up days for the market recently. The last two sessions for the market closed down, and this morning we are looking at even bigger losses. Dow futures right now indicated down by about 540 points after we heard from the Federal Reserve yesterday that they're going to be keeping rates at zero for a very long time to come. We knew that part of it. They also gave their economic forecast, and that may have been a little worse than some people had anticipated. They're looking for a decline of 6.5% in GDP for 2020. They do expect gains of 5% in 2021 and then 3.5% in 2022. But the reality of why they're going to be keeping rates low, maybe catching up with the market, also some concerns about what's happening with reopenings and some potential increases in cases for coronavirus in some of the states that have opened early. Let's also take a look at shares of Target this morning. The retailer just announcing a 3% dividend increase. That puts the dividend at 68 cents a share, up from the prior 66 cents. And this is kind of interesting for anybody who's looking for a dividend stock. The company points out that the third quarter dividend is going to be the company's 212th consecutive dividend that it's paid since October 1967 when the company went public. And with the increase that's announced today, 2020 is on track to be the 49th consecutive year in which Target has actually increased its annual dividend. So we talk about tough times when some companies have to cut their dividends. Others have to get rid of it entirely. That's not the case with Target. Obviously, we know it's been a retailer that has flourished in terms of the numbers of people going there. And this is just the news that they're giving us this morning. Andrew?
Okay. Thanks, Becky. The Fed seeing rates near zero through 2022. At that news conference yesterday, Chairman Jay Powell used phrases like, quote, considerable risks, and said that we will, quote, do whatever we can for as long as it takes to support the economy. And the professor joins us this morning, Steve Weissman, with more on all of it and how to read it, Steve. How to read it.
Yeah, I think, Andrew, the way to read it is the Fed throwing a little bit of cold water on the market's exuberance over the outlook. Look, he gave them everything they could have possibly wanted when it comes to the outlook for rates, but it's the outlook for the economy that was really the cold water on the market yesterday. Take a look. The Fed is saying it's projecting rates being low for years, all the way out through 2022. It's going to continue at least $120 billion of monthly QE. But the reasons for that, why is it doing it? It's doing it because it's going to be a very long road back. Becky was just talking about these numbers. Let me show you a graph with them. And first of all, the yellow line is the GDP outlook. It was going to be 2%, 3%, whatever it was going to be. Now it's going to be down 6.5% this year, up 5%. In other words, above trend the next 2 years. But you have to do the math on that. You don't get back where you were until the middle of 22 in terms of getting back lost GDP. Unemployment rate remains elevated throughout the 3-year projection phase there. So we don't get back to 3.5 in any kind of hurry. It takes a while to get there. Now, I asked Powell yesterday about the good news, about the idea that the job report was better than expected, and asked him how he would process that. And here's what he said.
We're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time.
And the reason for that is you have to take the ice cream you're getting with the idea that, hey, there's going to be something bad down the road here, which is why you're getting all that ice cream. And that is really because he does not see the labor market improving that quickly.
My assumption is that there will be a significant chunk well into the millions. I don't want to give you a number because it's going to be a guess, but well into the millions of people who don't get to go back to their old job. And in fact, there may not be a job in that industry for them for some time.
Andrew, Powell has always emphasized the uncertainty of outcomes. I feel like the change here among Powell and maybe other members of the Fed is they're now more certain of difficult outcomes than they were in the past. The idea that no matter what happens here, it's going to be a long road to recovery.
Steve, the question I'd ask you is, how much of a distinction you think there is between Jay Powell's view of the markets, between the administration's view of the markets, and the market's view of the markets, at least up until yesterday?
I mean, those are three questions. I think that Mnuchin, even yesterday, in arguing for additional stimulus, suggested that maybe it's not going to be such a quick rebound. Other members of the administration have been much more upbeat. And the market, I think, look, it's hard to say exactly what the market was thinking. I think the market thought it could get all of the good stuff, the low rates and the QE, without any of the bad stuff, and a quick recovery. And I think Powell yesterday put those two things together. Yeah, you're getting low rates, but you're getting low rates because the economy is just not going to get back to where it was as quickly as thought. And I don't know if yesterday was the sort of cold water that woke up the markets, if it saw the numbers the Fed put on it and the projections, or heard what Powell said. But there's a reason why rates are going to remain low. It's not all good that you're going to keep those rates at that level. It's because it's going to be challenged.
Yeah, you're talking about the type of economy we have that justifies what he's doing as being troubling. What about just the action, unprecedented in terms of just blowing out the modern monetary theory embrace of central bankers around the world? I mean, the people that have been preaching this, and obviously there's been no inflation and there's been, it hasn't come back to roost yet. But that's where a lot of it, I see a lot of it all the time on the internet and Twitter and everything else, that what the heck are we doing and how do we ever get out of this? That it's already out of control. The dollar's going to crash. All this kind of stuff is out there. Then he didn't even talk about that.
We talked about that. We talked about that yesterday. I don't know yet, Joe, if that's what's animating the market.
I don't either. But there are
my second question. My second question to Powell, if I got a second question, was going to be, you couldn't get out of a $4.5 trillion balance sheet. How do you expect to get out of a $10 trillion one? There is a reversal out there. I'm not sure that's part of what's animating the market here. And already fears of that. I think it's going to be a time.
Yeah.
Maybe it should be.
Maybe it should be. And maybe, these guys in Washington, how are they going to, what are we going to do about how they're spending? I mean, it's necessary, but, rates haven't gone up and there hasn't been any inflation.
Joe, if I could just say one thing about that.
Yeah.
I do want to say one thing about that, which I think is important, which is that most of the analysis that I read says it would be a lot worse if we didn't do these things. That the budget deficit would be even bigger if we weren't out there trying to provide stimulus and relief. That the Fed, that if you don't do these things, you have much worse outcomes. So that has to be balanced against whatever difficulties there are in extracting ourselves from.
It helps to have people working to pay taxes from the money that they're making. That's definitely might be better than having everyone unemployed. All right. Thanks, Steve. Joining us now, Paul Zemsky, Chief Investment Officer at Voya Investment Management, and John Hill, VP of U.S. Rates Strategy at BMO Capital. So, Paul, we were just talking about the Fed and rates. We could start with John, but Paul, I just want you to look at what we've been talking about in terms of the stock market and trying to wonder whether this 2-day sell-off, which is now 3 days, if it ends like this, is that the beginning of something that's going to take us back down, say something really troubling, like 50% of the comeback or something, or is this manageable and to be expected with the big gains we've had, Paul?
I really don't think we're heading for a 50% retracement. Look, the market's up 45% from the bottom measure in the S&P. That's a really big move. It's perfectly natural to have a retracement. 10% retracement from here would take us back to 2,900, and that was where we were in mid-May. So less than a month ago, we're at 2,900. We would have been really happy to get here. So it's perfectly normal to have a retracement with a rally like this. And as we were talking about, policy is set for the stock market to go up. There's no better time to be in stocks than when the economy is growing and the Fed is telling you they're not even thinking about raising rates. That's a good time for stocks, and this is just a blip on the road.
So you figure we can put it in the bank that the economy will be growing and that we're not all going to have to hunker down again at some point. We're beyond that?
There's always a chance of a really bad outcome, but the base case, which is 60 to 70% probability, is that we'll have really strong growth in the second half of this year, then tapering off, but still being above trend for 2021, as the Fed said yesterday, 5%. Yeah, that seems reasonable. But remember, the Fed put down negative 6.5% for 2020, but if the first half falls at negative 12, the second half is going to grow at roughly 8 or 10% to get you the negative 6.5% for the year. So we're going to grow.
So, John, from what you heard yesterday, was there anything that would cause you to say things were worse than you thought the day before, or pretty much in line and this is a normal reaction?
No, I think it was very much in line with what expectations could have been going in. You know, one of the things about this moment is things are so uncertain. They're uncertain both in terms of how the Fed will react. They're uncertain in terms of whether there will be a second wave, whether there will be another fiscal program. But even though there are some uncertainties, there are some things we know for sure. There are some certainties. And I agree wholeheartedly that we should expect continued support for asset prices, continued support for the economy, just simply because that's the way our political system works. That's the way our monetary system works. At the end of the day, you know, the Fed came in and committed basically open-ended to something like 1.4 trillion in QE for the foreseeable future, in addition to keeping rates pushed down at zero until we've weathered the storm. Whatever that precisely means is still a little bit difficult to say. You know, it's possible that some of the market wanted them to go one step further and announce yield curve control or something like that. So, you know, really what I see the market doing over the past 12 hours or so since the announcement is just recalibrating after that new information from Powell. You know, we do have rates at zero. We do have commitment to a QE program, and we do have commitment to scale that up and do more if necessary.
No negative rates, right, John, in your view?
No, certainly not. I think it makes sense for them to study it. You know, we're at a moment of really unprecedented stress on financial and economic system. Everything should be on the table. That doesn't mean you have to do everything. And what the Fed has really indicated is, hey, we've taken a look at negative rates. We've done briefings on it. Every single FOMC member who has commented on negative rates thinks it's not for the U.S. Right. It would do more harm than good. Sure, you're going to see some people push that trade in some elements of the futures market, but I don't think you have to.
That's one of my pet peeves, though, Will. Well, we're not going to do it, but we need to have that conversation. We have conversations about the most outlandish stuff, socially and everything else, that it's like, no, let's not have the conversation. We're never doing it. Stop saying that. What does that do? Conversation. Talk is cheap. Thank you. Thank you, John. It's okay. I'm kidding. It's just one of my things. And Paul, thank you. Appreciate it. We'll see you. Andrew.
Okay, coming up when we return, Dow futures down about 2% just this morning. We're going to much more on today's move before the opening bell. We'll talk about it when we return. As we head to a break, though, take a look at this morning's biggest decliners in the S&P 500. We're back in just a moment.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
With millions of podcasts dropping new episodes all the time, how do you keep up with all your favorites? TuneIn makes it easy. Simply head to the home screen and find your new episode section to see the latest additions.
Buckle up, race fans.
NASCAR is back in the driver's seat.
And you can cut straight to the action here.
With the Performance Racing Network on TuneIn, you can hear PRN's live coverage of some of this year's top events.
As NASCAR's top drivers, Kevin Harvick,
Clint Boyer, and more get back on the track.
Search Performance Racing Network to listen and see upcoming races. To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. CDC says there are still precautions to prevent the spread of COVID-19. Wash hands often for 20 seconds and encourage others to do the same. Use hand sanitizer with at least 60% alcohol if no soap or water is available. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Ready for a one-of-a-kind look at the NFL? On the PFF NFL podcast, Steve Palazzolo and Sam Munson interpret the unique stats of Pro Football Focus to analyze the league, uncover secret superstars, and discuss which teams to watch out for in the next Super Bowl.
Let's talk some football. Let's do it, Steve. All sorts of stuff. We're going to do most improved defenses around the NFL. Solomon Wilcots, our very own. He went into some detail over at PFF.com. Most improved defenses around the
Search PFF NFL on TuneIn to listen.
The right time with Bomani Jones.
While he was gone, Al had some kind of vote to make him the manager. You remember he used to come up all the time in the Raiders game that he was the manager.
Getting commission free today.
Still to come, the pressure is on for CEOs to make changes for racial equality. We have more on that story next. Right now, though, as we head to a break, check out shares of Amazon. The European Union will reportedly file charges against the company over its treatment of third-party sellers. That's according to the Wall Street Journal. We'll be right back.
How do you keep track of all your favorite stations and podcasts? Easy. You add them to your favorites list. Just find the audio you want to bookmark and tap the heart icon. Then, whenever you want to browse your favorites, you'll find everything under the Favorites tab.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Cover coughs and sneezes with a tissue, then throw the tissue away. Avoid touching your eyes, nose, and mouth with unwashed hands. Disinfect surfaces, bottles, handles, knobs, and other places touched often. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Ready to talk brass tacks on what's happening in Major League Baseball? Turn to the Effectively Wild podcast from Fangraphs for daily statistics, analysis, and commentary.
One team will say, yeah, we're going to keep paying minor leaguers their stipend, and another team will say, we're going to extend the stipend through this month, and then another team will say, nope, we're cutting them off. So are extending it at least through August, which would basically be the end of the minor league regular season.
Search Effectively Wild on TuneIn to listen.
Looking for your daily fix of NFL news and analysis?
In that. So we had to blow it up and do Super Bowl predictions instead.
Look no further than the Pick Six podcast, where CBS sports writer Will Brinson gets you up to speed with what's trending in the NFL that day, so that you're always in the know.
Yeah, it's pretty revealing of Brinson's methodology for predictions. When he gets mad at people for predicting good teams are going to win the Super Bowl or good players are going to win major awards, that's how you wind up.
Search Pick Six on TuneIn to listen.
Where do sports, culture, and basketball nostalgia collide? On their podcast, Knuckleheads, NBA veterans Quentin Richardson and Darius Miles sit down with athletes, musicians, and entertainers to get brutally honest, totally unguarded conversations about everything from current events to untold stories from the golden era of sports.
Meal. You
know that, right?
Meals ready in minutes. Skip the shopping, cooking, and cleaning. And get meals delivered fresh, not frozen, right to your door. Build your weekly menu today at Freshly.com.
Meet Gravity, the original weighted blanket for sleep, stress, and anxiety. Gravity is the only weighted blanket demonstrated to improve sleep and reduce stress. Now available in cooling for summer.
Following nationwide protests, many corporate executives have committed, at least vocally, for racial equality. But contributing to systemic change requires more than a press release. CNBC contributor Joanne Lippman writing today that as CEOs implement action plans to disrupt systemic racism in the United States, they can reflect on the Me Too movement for some ideas on what works in affecting change and what doesn't. Let's bring in Joanne Lippman. She is Distinguished Fellow for Journalism at the Institute for Advanced Study in Princeton. She's also a CNBC contributor. And Joanne, I know that for several years now, you've been traveling and talking to male executives, talking to them about the Me Too movement. And what you've seen happen there shows you a lot of parallels to the corporate response we're seeing right now to the Black Lives Matter movement. What are you kind of seeing there, and how do you think this kind of plays out from here?
Yeah, thanks, Becky. So there are a lot of parallels between what's going on now and the Me Too movement, and also a lot of lessons that we need to learn, because a lot of what happened, we're seeing the same playbook. We're seeing lots of corporate statements of support and maybe some donations. We're also seeing some CEOs who are starting to lose their positions, like CrossFit yesterday. I'm sure we're going to see more of that to come. And we're seeing the rise of this white allies movement. And I think this is really relevant because it's sort of an outgrowth of what we saw in the Me Too movement, where suddenly we had male allies. Male allies were people who said, oh, feminism, we never thought that was our cause, but now we want to help. White allies, we're seeing exactly the same thing. The issue is, if we look at what actually happened with the Me Too movement and what corporate changes happened, we really have not had a lot of movement. I mean, in terms of representation of women, in terms of promotions, in terms of pay, we're just not seeing the movement. And so if we want to avoid those same missteps now, we've really got to put words into action. And that is what's been missing from the Me Too movement. Something for all of us to learn.
Yeah.
So, I mean, there's a few steps there's some steps that yeah.
No, go ahead.
Yeah, there's steps that companies can take that have been effective and that we need to see more of. And by the way, what you just mentioned with Amazon, what you were talking about earlier, is really relevant here, right? We have known for years that the artificial intelligence software, facial recognition software, does not recognize black faces accurately. And it's only now that Amazon is doing something about it. If you look at representation in terms of companies, the tech firms, for example, have terrible representation of people of color, less than 4%, versus a black population that's like 13%. So, but there are things that you can do. One of the first things and the easiest that, you really got to trust your data and look at your data. And that means quantifying, first of all, promotion rates. Look at your promotion gap. So companies have gotten so much better than they used to be in terms of hiring at the entry level diverse candidates. But then if you look at every level going up, it becomes less and less diverse, more white, more male. And if companies are really serious about this, you got to look at where is the leakage, because it's not the problem of the employees. It's not that your employees aren't cutting it. It's that you've got some sort of structural bias built into your organization and you can pinpoint it there. And similarly, we've seen the same thing with wage gap analyses, which can be very helpful.
Joanne, I saw a strain on Twitter, a thread that had kind of run through just about, let's say, in journalism. Part of the reason that you don't see more diversity in journalism is because for a very long time, all of these newsrooms relied on unpaid internships, and that just cuts off a lot of people who have access to this. That seems to be like a pretty significant thing that should be considered.
And Becky, you're right. And not only that, it actually starts even before the internship. It starts in college. A lot of college newspapers is considered an extracurricular activity. Those students are blocked out. Students on financial aid, who disproportionately minority students, are actually cannot work on their student newspapers if the student newspapers don't provide a stipend, because they have to have a job to go with their student aid. So more colleges we see are now starting to pay. Then you go into the internship phase. If you're not unpaid internships. And by the way, also, the fact that in journalism in particular, those entry level jobs are very poorly paid. So that's another issue to deal with. But there's another issue that I think is really important, which is who's doing the interviewing, who's making the decisions, who are the decision makers about who's hiring, and also who's getting promoted, like who is making those decisions. There's in football, Becky, I know you know this, there's the Rooney Rule that if you're hiring a coach, you've got to include a diverse slate of candidates. Every company should have a Rooney Rule for their candidates, but they also need a similar Rooney Rule for their interviewers, because if you've got if your interviewers, your people who make the decisions are largely white men, and you've got a diverse slate of candidates, you're not going to get the optimal result. And so you want to have that ability to understand, to have people who are making those decisions who have diverse points of view.
Joanne, thank you. We are out of time. It's great to see you.
And there's other steps that people...
Thank you very much. It's great to see you, Joanne. And
yes,
if you want to see
great
the full
to
article,
see
you
you.
can go to Avoiding Me Too's Missteps. You can go to CNBC.com for that. Squawk Box will be right back.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
Looking to freshen up your listening on TuneIn? Head to the homepage to discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the homepage.
As the science and medical world continues to learn more about COVID-19, we're all learning how to best live with it. Because the news is always changing, TuneIn helps you make sure you're getting the latest information on the pandemic with live streams of CNN, MSNBC, BBC, and more. Plus, evidence-driven podcasts like Coronavirus, Fact versus Fiction, and Podcast 19. For the latest stories and reports, search Coronavirus News on TuneIn.
Brian Windhorst and the Hoop Collective Podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a Supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen.
Okay, here we go.
With the NFL draft in the books and the schedule set, check out a TuneIn podcast for daily updates on the lead up to the 2020 season. Like the Ringer NFL show, where a rotating cast of Ringer experts talk with players, coaches, and special guests about the NFL landscape.
A lot of the other teams that we consider...
Or ESPN's NFL Live.
If there are some delays because of the COVID-19...
Search sports on TuneIn to explore these pods and much more.
About 8 yards, tweaking the loft a little bit. You are now maximizing your ball speed. We found 12 yards of carry. You now have a driver that is 100% fit to you.
Golf Galaxy stores are now open in many areas, and we've implemented new contactless club fitting with enhanced safety measures. Get the perfect fit at Golf Galaxy.
Market sell-off. Dow futures pointing to a sharp drop at the open. The Fed's outlook fueling move this morning. A complete rundown of what you need to watch is straight ahead. Plus, the CEO of Honeywell on the company's efforts during the pandemic. And an update on COVID hotspots and what's driving the spike in cases in states like Arizona and Texas. It's all straight ahead as the second hour of Squawk Box begins right now.
Guess we can keep that promo where we're all like this far apart from each other. It looks weird now to me, though. We should, I don't know. Good morning. Welcome back to Squawk Box here on CNBC. Those were the good old days. I'm Joe Kernan, along with Becky Quick and Andrew Ross Sorkin. Let's talk about U.S. equity futures. Just to make one additional point, the Dow is indicated sharply lower, down about 565 points after a couple of back-to-back losses. And today, the NASDAQ is down significantly, but we should point out that the previous two sessions, the NASDAQ continued to outperform and was actually at levels never seen before. We should also maybe focus on the S&P just as much as the Dow. The S&P closed last night at about 3190. So if you take another 60 points off there, we're still above 3100. A lot of people thought 3200 would be a good year-end target, even if everything worked out and they were very bullish. So we're still definitely near the high end of forecasts and ranges. So we'll see whether this is the beginning of something more significant or a normal pullback. Bonds, which were interest rates were sort of going in sync with the positive movement we saw in equity markets, with rates rising to where we almost saw the 10-year back at 1%. So you can see now that that didn't happen. We've gone from 0.9 back down to 0.7. Oil has maintained its recent move higher, back to almost 40, although it's down a little bit today at 38 for WTI. Becky.
All right, Joe, thank you. Software industrial conglomerate Honeywell, one of a number of corporations stepping up to the pandemic to produce PPE to try and reduce the spread of coronavirus. Joining us right now, a partnership with one of the top players in the cloud and something you are working on again to try and stop the spread of coronavirus. Why don't you tell us about that?
Good morning, Becky. Nice to see you again. Nice to be with you. Today is a very exciting day for us. We're going to be announcing a partnership with SAP. It's a natural partnership with their expertise in the ERP space and the IT space and our expertise in the OT space. It's kind of a natural marriage and natural partnership. And the focus is going to be a cloud-based solutions based on our Forge platform and their SAP platform for our connected buildings offering. We think that this is an exciting day for building owners, building operators, as we're going to be bringing substantial energy savings. We're going to be bringing a better occupant experience. And I think what's really most important, especially in these times, is we're going to be bringing employees back to a much safer environment. Initially when the COVID crisis hit, we responded very quickly and effectively to make sure that we bring the solutions that were needed, whether it's N95 masks or sensors for ventilators or hand sanitizers, where we converted two of our plants to make hand sanitizer. What we're focusing our energy on now is how does the world operate in this quasi state between a full medical solution and then fully working from home. And part of that solution is going to be our healthier buildings offering, which is going to offer improved air circulation, cleaner air through the use of UV lights. Some of our AI technologies are going to make sure that people are social distancing. Some of our Rebellion cameras not only will measure temperatures on people entering the building, but even through the use of AI, make sure that they're actually wearing PPE in a proper way. So we think that this is going to be a great solution for people to transition back to the offices.
Darius, I mean, that's huge, and I think it would make people feel much more comfortable if they knew they could come into these environments, because so much of what we've heard to this point is that inside air circulation could be a serious problem. We've watched it in diagrams where you can see, for instance, at a restaurant or at a church or something, where they map out how close you're sitting to people and how many people on this floor of the office actually got it after one person came down with coronavirus. What you're talking about sounds pretty intense. How quickly can you roll some of these things out? How quickly would you be able to scale this up? I know that you have a huge presence when it comes to these non-residential buildings. Over 25% of the world's non-residential buildings are actually powered by Honeywell. So how quickly could you roll out solutions like this?
We're ready to engage customers right now. These solutions are ready. They're ready to go. We're starting to roll them out in some of the Honeywell buildings. So we're certainly ready to go right now to engage customers in some of those discussions. And I would just also point out that our solutions are not just limited to buildings. For example, we've also created a set of solutions for the airlines. I've happened to have some discussions with the airline CEOs, a number of them earlier this week, about how do we make travel safer for passengers. And we had some ideas. They have a number of ideas, but we're all focused on the same thing, which is how do we make that environment safer? And the same kinds of things, which is healthier air circulation, making sure that the cabin is clean, that it's been disinfected, that passengers at the end of the day need to feel safer in their travel. So we have a similar set of solutions there. We have them for industrial plant, cybersecurity, all these things that are going to become so relevant now as the world gets back to work.
You say you have these solutions that are ready to roll out right now. A couple of questions. What's it cost? And how, as an employee going into a building, as an air traveler, how would I know those things are in there? Because everybody is kind of ramping up with these partnerships right now. We heard that AMC theaters are teaming up with Clorox to try and make people feel better about the idea that they're cleaning things more thoroughly. What you're talking about makes me feel a little more comfortable in terms of the ultraviolet rays in the duct systems and trying to make sure that people actually are social distancing. But what does it cost, and when are we actually going to see, let's say, Manhattan having all of this, or know that any flight that I would book would actually have something like that?
Yeah, the costs are actually variable based on the size of the building, number of occupants, and so on. So, but the way that you're going to know that these systems are in place, for example, for our building offerings, every office occupant is going to have a user app where they could look up exactly what's happening. On a daily basis, they're going to get a questionnaire in terms of who have they been around, what they've done. So we're, incorporating another safety feature into this. They can look up at the air quality. They can take a look at, who's been around them in case there is somebody who comes down positive tested for COVID. So it's a fairly sophisticated user application as well that will further enable employees to feel safer in that environment. So it's going to be very visible to anybody coming in, particularly also if they use some of our Rebellion cameras, which will measure temperature as well as check for PPE or whatever other functionality that the given user would want to have in that building.
I would imagine in China they may roll some of that stuff out immediately, but maybe in the United States there are some questions about privacy. And I ask that because even when we were in the heat of the virus in New York City and other places, privacy concerns are a big issue, particularly with talking about people's health. And there were times where you're not even told in your own workplace if someone tests positive or who that person is. Maybe you hear that there was a positive case in the workplace, but you don't know who it is because of privacy concerns and health concerns. How do you deal with those issues?
Yeah, I think that's a very legitimate point. Privacy issues something we have to deal with. We've actually managed the whole COVID crisis very well. We've had very, very few outbreaks throughout our 110,000 employees. But we've had a couple, and frankly, you can still manage this without telling people exactly who's been tested positive for the virus. You have to take a look at where that person works, who they've been around, and so on. And I think you can do that in a way which still protects people's privacy without divulging, who's been tested positive and so on. And, that's part of the solution as well as keeping those the people's privacy such that it's not evident to everybody in the office or the manufacturing center exactly who it is and what they've tested for, because those issues are critical and important.
Darius, what does the economy look like from your perspective? What do you see happening around the globe as places like China and Europe start to open up and as some of the states here start to open too?
Yeah, I would say so far it's very consistent with what we've expected. I mean, essentially, what we expected and continue to see in the results is a little bit of a steady progression. So, I would define April as our low point. May was a little bit better. We expect June to be better, Q3 to be better, Q4 to be better, and then 2021 to be better. That's the basic financial model, and whether it's our aerospace business, whether it's our performance material business, it's starting to follow similar types of trends. Now, the big unknown here, and Dr. Gottlieb talked about this, when he's on your show, which is, what's really going to happen in the fall. Now, we're optimistic. I think we're much more ready to deal with potentially a second outbreak. The mortality rates are dropping, so the treatments that are being administered in the hospitals are much more effective. We do think that progress is going to be made in terms of a medical solution, even in the fall or late this year. So we think that the chances of another major event when everybody gets sent back to their homes, the economy is locked up, the probability of that we anticipate to be pretty low. So we see some level of recovery. We're not expecting a V-shaped recovery, but we are expecting a gradual improvement as we move throughout the year and certainly into 2021.
Darius, we want to thank you very much for your time today. I wish we had more time to speak with you, but hopefully you can come back soon. Tell us how things are progressing, and we appreciate hearing this update about this new news today, too.
Sure. Thank you, Becky.
Great to see you. Andrew?
Good to see you.
Hey, thanks. Great conversation. Fascinating what it could mean for all of us. In the meantime, take a look at futures. Right now, we're in the red this morning. We are in the red in a relatively big way. The Dow off about 630 points this morning. NASDAQ down about 154 points. S&P 500 looking down about 63 points, giving up a lot of the gains over the past couple of days, or at least some of those gains. As we head to a break, a look at this morning's leaders and laggards in the Dow. We're right back after this to discuss what's happening in the market.
wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history.
There it goes, 3-2 pitches, hit in the air and hit well. Center field, Bader back, at the wall, it's gone!
Search classic game replays to relive some of the great contests in America's pastime.
Ground ball out to Jackie Robinson, up with it, over to Reese for one, back to Hodges. It gets away from him. Barrows trying to go to second. Hodges.
It's on demand, it's free, and it's only on TuneIn.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Avoid close contact with people who are sick. Remember, 6 feet. It's the rule. Stay your distance and always wear a mask while you're out. Avoid close contact with people who are sick. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Introducing a new podcast, ESPN Daily, hosted by me, Mina Kimes. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily. Go deeper into the stories of the moment. Get the exclusive access and insider perspective that only ESPN can give you. The best sports story all day, 20 minutes a day, 5 days a week. ESPN Daily.
Search ESPN Daily to listen.
If your credit card debt is out of control, if you're in over your head in monthly payments, there's a secret the credit card companies don't want you to know. If you have more than $10,000 in credit card debt, you have the right to let us settle that debt for a fraction of what you owe. That's bad news for the credit card companies, but it's great news for you. We're Credit Associates, and we're offering you free information on how to completely resolve your credit card debt with a monthly payment you can afford. To see how much you could save, call now. 1-800-933-4101. Don't declare bankruptcy. Don't consolidate. Give us 10 minutes and we can save you thousands. After all, we depend on your success and offer a guarantee so there's no risk to call. Credit Associates. Live better, debt-free. Find out how easy it is by calling now. For the secret the credit card companies don't want you to know, call Credit Associates now and see how much money you could save for free. Call 1-800-933-4101.
Breaking news on Regeneron. Let's get right to Meg Terrell, who has a special guest. Hi, Meg.
Hi, Joe. That special guest is Regeneron Chief Scientific Officer Dr. George Yancopoulos, with the news that the company has just begun the first clinical trials of their antibody cocktail for COVID-19. Dr. Yancopoulos, thanks for being with us this morning. You know, you've laid out a pretty substantial clinical trial plan here with 4 different study arms evaluating both prevention and treatment with this drug. Tell us about this approach.
Well, before we get into the trials, let me just start with the science and technology, because that's where it always starts at Regeneron. And I do have to pause for a second here to consider what's happened here, because I'm not sure it's ever happened before. On the very same day that we announced publication of fundamental new scientific discoveries in back-to-back papers in the world's premier scientific journal, well, on that very same day, we announced that we are taking advantage of these discoveries already to start and treat patients. We've already treated our first patient suffering from this horrific pandemic. And I think it speaks to the incredible effort and dedication by so many throughout our bio industry, and particularly the incredible effort of our scientists and people who, ever since we realized this incredible challenge that was put to the world, they've been working 24/7, combining their incredible ingenuity and old-fashioned blood, sweat, and tears to turn this into a reality, to try to save mankind. So I'm very proud of the entire bio industry, and particularly our people, for making the science and technological discoveries and bringing them so rapidly to this point, which, as you say, we're starting to test them in trials. And we have a very aggressive program. We work very closely with the FDA, a very innovative new way to combine all phases of testing, aggressive phase 1, phase 2, phase 3 adaptive design, where very rapidly we will hopefully be able to quickly test the safety and then start understanding the efficacy for 4 major different settings of this virus challenge. 1, to treat the sickest patients, those who are in the hospital, who are on ventilators or requiring oxygen support. That's one class, the hospitalized patients. 2 is the people who are infected in early stages of disease, showing that we can stop the disease, reverse it, so they don't progress, and rapidly cure them and make them non-infectious. 3rd, to treat and prevent disease in the context of these very people who have recently been infected. And 4th, as a widespread prophylactic to prevent disease in people who are at high risk. For example, the heroes who are working at the front lines, the healthcare workers and so forth, to make sure that we have something to give them so that they will be able to do their job and not worry about getting infected.
Well, I want to ask you also about those scientific discoveries you just mentioned. So you have 2 papers that have been accepted by the journal Science. We're going to get to see them on Monday. But essentially what they show that you've detailed today is that a cocktail approach with antibodies can do similar things to what we saw with cocktails with antiviral drugs for HIV, which is potentially protect against the virus's ability for mutants to evade one single drug approach. Now, your competitors, like Eli Lilly, have started human trials with one antibody. Are you concerned that that approach is going to lead to mutant versions of the virus getting around that drug?
Yeah, first of all, I don't view any of us during this pandemic as competitors. I think we're all working and we're doing our best together. As you said, I think that the fundamental discoveries that we showed in the scientific papers now is that just like with conventional old-fashioned antiviral drugs, giving one can have enormous benefit initially, but it can lead to the selection and the arise of escape viral mutants, which now could be very dangerous and risky. And what we showed is that in order to prevent this, you have to give these antibodies in cocktails. I think that there are very serious risks to consider, that we do not want to be selecting the same type of escape drug-resistant mutants with single antibodies as was seen in the early days of HIV and AIDS. And I hope that everybody out there who's considering using single antibodies looks at the data, looks at the science, and considers those risks. And I think when we have an antibody cocktail like this available, the one that is already now in clinical trials, I think that people should think about whether they should be proceeding with single antibody trials.
What do your timelines look like in terms of getting the first information back about how well your drug is working?
Well, we're hoping within a week or 2, using this adaptive design, to be showing that it's safer to go into larger numbers of patients. Once we're able to do that, and this is going to be a collaboration working hand in hand and side by side with the FDA, we're going to be going to larger numbers of patients. And we think that it's possible if all goes well. Remember, this is biology and medicine. And a lot of times you can't predict how things are going to go. But if things go incredibly well, within a month or 2 after that, we could have definitive data that this antibody cocktail is really making a difference for a variety of these patients at risk. And I think there's a lot of reason for hope. Remember, we first pioneered these very same technologies, creating an antibody cocktail against Ebola. And remember that in a collaboration with the World Health Organization, that was tested in the Congo, and it went head to head against old-fashioned repurposed drugs like remdesivir that we're all hearing about. And it had remarkably greater benefit there in Ebola, which is a much more universally lethal disease. So we think there's a lot of reason to have hope here. But like anything in this field, in science and technology, biology can always surprise us. So there's always reasons to be concerned and to be cautious. So we're going to be moving forward very carefully, hand in hand with the FDA. And we hope sooner rather than later, we can get answers that will really make a difference.
All right, Dr. Yancopoulos, thanks for being with us. We'll stay tuned for those data in just a month or 2, hopefully. Becky, back over to you.
Meg, thank you very much. Folks, let's take a look at the futures this morning. We have seen increasing pressure on those futures. In fact, the Dow right now indicated down a spooky 666. S&P futures down by 66. The NASDAQ indicated down by 160. We've also seen oil get weaker. It's down by more than 4% to below $38 a barrel. We'll talk more about what's been happening. Also, take a look at bond yields. Those bond yields came under pressure starting yesterday with the Fed, too, and 10-year now indicated 0.7%. The Fed sees rates staying near zero through 2022. Market kind of knew that. It's the concern about the economic outlook. They do see a decline in GDP of 6.5%. Also fears of a second wave growing, all of that putting pressure on rates this morning. As we head to a break, let's take a look at today's Aflac trivia question. Which popular vehicle maker's slogan is "Think Outside"? We'll give you the answer when we come right back.
The Mina Kimes Show podcast.
Kevin Clark.
If Josh Allen became the 10th best quarterback in football this year, they'd probably win 14 games. Am I wrong about that?
No. If you as a quarterback can't win in the Bills' situation right now, they should not extend you. So many teams, Jets, do not have the information they need to evaluate their quarterbacks based on the teams they built around. The Bills do.
Listen and subscribe to the Mina Kimes Show podcast.
Search the Mina Kimes Show to listen.
Get to know us at Aflac.com.
Interactive Brokers charges 1.55% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab, to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
Need better sleep? Try Nature's Bounty Sleep 3, a unique tri-layer supplement that calms you, helps you fall asleep faster, and stay asleep longer. Great sleep comes naturally with Sleep 3, only from Nature's Bounty.
Land Rover, above and beyond.
Consistency can deliver on investment goals. Columbia Threadneedle Investments.
States of Play, CNBC and Change Research's exclusive survey. How the virus and economic crisis is impacting the critical swing states that'll decide the election. Special reports all week and on CNBC.com.
Welcome back. Now the answer to today's Aflac trivia question. Which popular vehicle maker's slogan is "Think Outside"? The answer, Polaris. And check out the move in the stock since April as people look to get outside. Been a V that's the other side's almost above the left side. But year to date, we should point out stocks down about 5%. Andrew.
Okay, a lot more to come right here on Squawk Box. Fed gloom and doom and some fears of a second wave fueling this morning's sell-off. We're going to speak to Grant's Interest Rate Observer founder, Jim Grant, in just a bit about the move in the markets and the Fed and all of it. And then shares of Grubhub, they're jumping after the company announced it plans to merge with European food delivery company JustEatTakeaway.com, beating Uber's offer, which valued Grubhub at about $70 per share. Just Eat Takeaway's offer at about $75.15 per share, though given the way some of the stocks have moved, we can talk about what it means. As we head to a break, another check on the futures. We are in the red this morning. We'll be right back right after this.
Hi, this is Mike Tirico, introducing you to Sports Uncovered, the newest podcast series from the storytellers at NBC Sports that will shine a fresh light on the most unforgettable moments in sport.
The reason why I'm smiling, I might get in trouble for this.
Search Sports Uncovered to start listening today.
Allergies. We're Weaver, a national CPA and advisory firm.
And we firmly believe that it's important to build rapport before reports. Weaver, accounting for more than numbers.
Here's your chance to learn at home and create a rewarding career. Go to mycomputercareer.edu and take the free career evaluation right now. You could start your new life as an IT pro in months. Classes meet live online just twice a week. It's not rocket science. It's mycomputercareer.edu.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Tonight, your playbook for navigating the new normal, reviving our economy, restoring American business, renewing hope for our communities. A CNBC special report tonight, 7 Eastern. Watch and listen live on the CNBC app.
Trey Wingo here from ESPN's Golic and Wingo. Every morning, Mike Golic Jr. and I sit down to discuss all the news, drama, and highlights spinning the sports world that day. And with TuneIn, you can hear us whenever and wherever you go. Just search Golic and Wingo and start listening today.
Treated by a licensed medical professional, all from the comfort of your own home. Visits are confidential and affordable. Need a prescription? Your doctor can send it to your pharmacy or have it mailed to you. Get the healthcare you deserve at GoodRx.com.
This is cellulose acetate, a plant-based material that's not only extremely durable, but also quite flexible, making it ideal for Warby Parker glasses, which, by the way, start at $95, including prescription lenses. Try 5 pairs for free at warbyparker.com. Oh yeah, about those prescription lenses. Warby Parker glasses come standard with custom-cut polycarbonate lenses that have been treated with scratch-resistant and anti-reflective coatings. Nice. Try 5 pairs for free at warbyparker.com.
Welcome back to Squawk Box this morning. Futures right now, we are in the red, and you can take a look right there. The Dow off about 645 points. S&P 500 looking to open down about 65 points. NASDAQ off about 160 points. And we should tell you there's a new dynamic in the market. Retail investors are making big bets on companies in or near bankruptcy, and it seems to be paying off at the expense of hedge fund managers caught on the wrong side of this trade. I want to get over to Leslie Picker, who's been spending a lot of time drilling down into almost day trading bankrupt companies these days. Leslie.
Thank you, Andrew. That's right. The smart money has really been dumbfounded here. The laws of finance say that equity holders rarely recover money in bankruptcy because bondholders, in order of seniority, get paid out first. So when shares of companies in Chapter 11 proceedings like Hertz and Whiting Petroleum began soaring, it defied all investor logic. But the retail investors who were buying up shares in these companies didn't really need logic. They just needed a way to make a quick buck, as you mentioned, at the expense of some sophisticated hedge funds on the other side of that trade. Now, the hedge fund strategy is called capital structure arbitrage, or colloquially cap structure ARB. Oftentimes, when it comes to a distressed company, this involves shorting the equity while going long the bonds to capture mispricings up and down the capital structure. The idea is that stocks and bonds can trade differently during the restructuring process, and algorithmic trading can kind of come in and capture that relative value. But when day traders started bidding up shares of bankrupt companies, it caused a short squeeze, sending those stocks even higher as hedge funds were forced to cover their short positions, guys.
Okay. Leslie Picker, thank you for that. It helped explain a lot of it. We've been debating what's been going on, and I think for a lot of us who've watched this over the years, it's been a very unique shift in what's happening in the markets. For now, though, on what's happening in the markets and who's getting into the markets amid all these wild market moves, I want to bring in Paul Hickey. He's co-founder of Bespoke Investment Group. Also want to bring in Mike Santoli, CNBC senior markets commentator. Let me start, though, with you, Paul. You've been looking at some really interesting numbers about what happens before and after the markets are open. And you've come up with a pretty unique explanation that actually maybe we should really change the way we're all trading.
Well, I think when you look at the long-term performance of the market, virtually all of the market's gains historically. Yeah, I'm here. Can you hear me?
Yep. Go ahead.
Okay, so virtually all the market's gains have come during the overnight session of trading, and it makes sense when you think about it because investors are taking the overnight risk. There should be no premium to equities or no extra compensation to hold equities during the day, because you can always get out of that position. It's holding the position overnight where investors have been rewarded for taking on that risk. The reason they take on that risk is and are compensated for it is for reasons like we saw in February and March, when good or bad news tends to happen in after-hours trading, and it happened in a big way in February and March. Conversely, the regular session, what we've seen is, like we said, that performance has historically been relatively weak. But what we've seen ever since, especially since last October, is regular session performance of the market doing much better. And if you look back to early October of last year, a big switch that changed was commissions at Schwab and other online brokers went to zero. So you've seen an increase in activity among, say, the retail trade. And you can also look at this in the breakdown of stocks based on their share price. Since October, when commissions went to zero at the online brokerages, the lowest priced stocks in the Russell 3000 have been the best performing stocks versus every other share price. And then if you compare that to the year before commissions went down to zero, they were among the worst performing groups of stocks. So lower price stocks tend to be weaker, lower quality stocks. But when it's a small share price and you have a limited capital, you tend to see retail money going into that area of the market.
Hey, Mike, let's put this in context for the viewers, because I think we should all just set up a programmatic trade here. It looks like since 1993, if you bought at the close and you sold at the open, that's all you did every single day, you would be up 650% on the S&P.
Yeah.
If you bought at the open and you just sold at the close every single day, you would be down 3%. So should we just put a programmatic trade on and go home?
Well, you're going to have to, make your way across a lot of interim losses. You're going to have to add to that account certain times. But by the way, I think there actually is a little pocket of the investment world that does something very much like that. And by the way, it makes sense, not just because, as Paul said, you're taking the overnight risk. There has to be some implicit compensation for that. More news happens outside of market hours than before. The rest of the world still exists outside of U.S. market hours. So I do think you're going to have enough kind of switchbacks and bumps along the way. And that's one of those trading strategies where, because of the enormous sample size of all the days you're calculating, it seems like a slam dunk, but there'll be long stretches where, you're not going to feel as if it's all that smart. So, it makes sense on some level. What is interesting to me, though, is if this is a change in the rhythm, or at least over the last several months, you have seen a little bit more of a bell-to-bell type of a push for people to buy stocks. And retail is mostly on the buy side, mostly pushing certain segments of the market. The issue is small traders, trading itself is kind of a zero-sum game during the day. So that isn't necessarily an ongoing source of new money into the market. It's a little more just kind of a little bit of a sideshow, a little bit of a speculative area of the market that gets moving when bull markets have been around a while, or when you've had massive volatility as we have in the last few months.
Hey, Paul, just speak to where we are in the markets right now. Clearly, go ahead. I just wanted to also get your ideas on where we are in the markets right now, given that we seem to be pulling back.
Yeah, I think today is, the market's a little bit concerned about the upticks in case counts in certain states. But, I think the market maybe got a little bit ahead of itself, pricing in a very smooth recovery going forward into the summer, into the fall. But there's going to be bumps in the road. And I think when you look at an issue like today, it's just one of those investors taking profits on concerns. But when we're looking and listening to the internals of the market, we're continuing to see positive signs. For instance, I mentioned this pretty much every time I'm on, but the relative strength of the semis hit another record high yesterday, and they're one of the best leading indicators for the broader market. So as long as that holds up, we're more comfortable than uncomfortable with equities.
And in terms of professional investor versus retail investor, how do you see this playing out right now? In terms of, there's a view, we were talking about those bankrupt companies, that the retail investor is actually moving a lot of this. Is that really what's happening here in the rest of the market, or no?
Yeah, so I think there's some retail money coming in, but we always, the retail money is always referred to as, say, the dumb money. I think if you look at hedge fund returns historically, equity hedge funds are flat over the last 15 years, according to hedge fund research indices. So I'm not necessarily sure that the hedge fund money is the smart money here or that the retail money is the dumb money. I think when you just look at the overall trends of accumulation, whether it be retail money or institutional money, that's what drives stock prices higher. And as you see that money coming in, which we're seeing, as Mike was saying earlier, it tends to be a zero-sum game, just day trading, but that's money consistently coming in, and that's driving the market higher.
Right. Hey, Mike, we got to run, but just give me your 30-second assessment of the market this morning, given where futures are, what you think is really happening.
Yeah,
is this just taking profits, or is there something larger happening?
Look, at this point, it does seem as if, I've been talking for a couple of weeks, but the speculation in the options market, the overheating of the indexes, you had a lot of stocks that had gone a long way in a hurry. It seemed like we're ripe for something like this. Last 2 days, the average stock's down a few percent, so it does make sense. But look, the beginning of a routine pullback looks the same as a more significant one. Right now, it's routine. We'll see how it goes.
Okay. Paul, Mike, thank you guys both. Appreciate it. Joe, over to you.
All right, coming up,
thanks a lot.
You're welcome. A look at rising coronavirus hotspots and what's driving the spike in cases. As we head to break, here's a look at the S&P winners and losers this morning. And Regeneron up almost 3%, 16 points on what we were just talking about with Meg Terrell and the Chief Scientific Officer. We'll be right back.
Organizing your finances can be overwhelming. You've got a mortgage here, loans there, savings and investment accounts, and a million other documents stuffed in that shoebox. There's an easier way with Stifel Wealth Tracker, a free app that brings all of your information into a single secure location. Automatically create your personal balance sheet, view your expenses, understand your investments, and finally, organize your finances. Download Stifel Wealth Tracker and get back to what's really important.
As business moves forward, we're all changing the way things get done. Like how we redefine collaboration, how we come up with new ways to serve our customers and deliver our products.
This one is cheddar. It's delicious. Oh, you look so healthy.
But no matter how things change, one thing never will. You can rely on the people and the network of AT&T to help keep your business connected.
At Amica, we believe in life's extraordinary experiences. We are an insurance company that delivers an experience that meets the only standards higher than ours. Yours. Experience Amica. Auto, home, and life insurance.
Yes, the first word to any adventure. But when allergies and congestion strike, take Allegra D, a non-drowsy antihistamine plus a powerful decongestant. So you can always say yes to putting your true colors on display. Say yes to Allegra D.
How about Phil Mickelson, Dustin Johnson, Justin Thomas? Here comes Ricky.
PGA Tour Golf is back at the Charles Schwab Challenge today, beginning at noon on Golf.
Welcome back, everybody. Let's take a look at the futures this morning. If you're just logging in on this, you're going to see that the Dow is down by about 650 points this morning. S&P down by 63, the NASDAQ off by 146. It does come after some big run-ups that we've seen in recent weeks, though. As states reopen across America, the new cases or hospitalizations from COVID are accelerating once again. Meg Terrell joins us right now with a look at the COVID hotspots and what's been driving the spike in those areas. And Meg, this is a concerning story.
It is, Becky. I mean, if you look at the country right now, it really is in two different situations. States like us in the Northeast are in recovery, whereas states in the South and parts of the West are really starting to see an increase after having reopened a few weeks ago. Specifically, epidemiologists are pointing out Texas, Florida, and Arizona. And we really want to home in on Arizona right now. If you take a look at the graph of their cases, you can see the reopening was in the early to middle of May. That blue line is the daily confirmed cases, and you are seeing a spike there. Now, there is some question of, is this just due to increased testing? Well, the red line is the test positive rate, and in Arizona, that's approaching 13%, and it's increasing. I've talked with experts there, including Dr. Michael Dake at the University of Arizona, who said this is not just increased testing. We are actually seeing more infection here. And when you look at the specific areas of the state, specifically Phoenix is an area that saw the fastest growth in the entire country of cases in the past week. And you can see here for Arizona, this is Apple's mobility data. People are starting to move around again. This is driving data showing it's reached baseline levels and even a little bit higher than baseline levels again after dropping down when everything closed down. So they do say this is probably associated with reopening. And one factor, guys, that we've been talking about this morning is that in many of these very hot states, we're actually in indoor season, people coming back inside and staying closer together, and that could be contributing to spread. Here's an interesting look, if you want to really drill down to the county level, at potential hotspots. This is a combination of potential indicators from Carnegie Mellon and other researchers. The darker areas are where people are going to the doctor or doing telemedicine visits for COVID. They're Googling COVID. They are reporting on Facebook surveys that they have symptoms or somebody they know has symptoms. And you can see a lot of places, California, Arizona, southern part of Florida, you are seeing that a lot more. So we could see potential upticks there, guys. Back over to you.
Hey, Meg, I guess the question is, because these are the states that are open and opened up, would we see similar trends here as places in the Northeast where, you know, these were the hotspots originally? Things have died down a bit. But if we start to open up like we are gradually starting to do right now, will those similar trends pick up here?
I've asked epidemiologists that question because I'm wondering the same thing. Are we just a few weeks away from seeing a similar spike like they're seeing in Arizona? And the answer they're giving me is they just don't know. I mean, this is a new disease. We don't know what the trends are going to look like. But one thing they will note about Arizona is that they didn't see this spike already that we've seen here in the Northeast. Dr. Dake was telling me they were kind of expecting this surge to potentially come in June because they really hadn't seen it before. So different curves, but we're going to have to see how it looks as we reopen and what steps we take to try to be careful.
Okay. Meg, thank you very much. It's great to see you again. When we come back, Jim Grant talks interest rates, the Fed's outlook for the economy, and much more. Before we head to a break, though, take a look at airline stocks. They're lower this morning. Few news items. Yesterday, United said passengers will have to answer a health self-assessment as they check in for flights. American Airlines CEO Doug Parker said demand is returning slowly, but flight volume for this fall and next summer remains pretty uncertain. And then Delta said that it's issuing new debt to raise an additional $1.25 billion. Of course, all of these stocks have run up significantly over the last week. But this morning, American's down by 10%, United's off by 13%, Delta down by 12%, Southwest off by 10%, and then JetBlue down by almost 12%. We'll be right back.
Gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Our business hasn't experienced anything like this.
We have to transform our workforce fast.
We need guidance. Who can help?
That's what Kelly does. We can help your business meet this challenge by providing you with the right talent solutions. Visit that'swhatkellydoes.com.
I'm Doug Hirsch. You may already know that GoodRx can help you save up to 80% on your prescriptions. Unfortunately, many Americans can't get to a doctor right now. The good news is that for many health issues, you can see a doctor online. It's easy. Just go to GoodRx.com, and with a few clicks, you'll be treated by a licensed medical professional, all from the comfort of your own home. Visits are confidential and affordable. Need a prescription? Your doctor can send it to your pharmacy or have it mailed to you. Get the healthcare you deserve at GoodRx.com.
This isn't dry food or wet food. It's not burnt brown pellets. The farmer's dog makes it simple to feed your dog real food. It's real meat and veggies. Freshly made, developed with vets, delivered right to your door. That's why dog lovers are choosing the farmer's dog. A smarter, healthier pet food. Delivered. Visit tryfarmersdog.com and get 50% off your first box of food.
The futures are at some of the worst levels we've seen in the pre-market, down 680 points on the Dow. The NASDAQ indicated down just under 150. S&P indicated down 66. And it's pretty much across the board. Just to look at three representative issues in the Dow, Boeing is the biggest loser this morning. It's down 9%, $18, which adds a lot to the to what you're seeing on the Dow sell-off. ExxonMobil in the oil group is down. Integrated Oil Group down 5%, over 5%, almost 5.5%, down 3 at 47. And then in financials, J.P. Morgan Chase is down about 4% in the pre-market. Benchmark interest rates are near zero. The Fed made quite a bit of comments yesterday, and some people indicating that those comments are unhelpful in terms of what's happening in the stock market today. Let's get to Jim Grant quickly here to discuss what this could mean. Is Jim Grant, founder and editor of Grant's Interest Rate Observer. And I'll start, Jim, with what I was talking to Steve Leisman about earlier. Many people are saying that the Fed's appraisal of the economy put a damper on sentiment today for the stock market. And I just asked a question about whether the Fed's overall action and the action of central bankers around the world, is there anyone worried about a day of reckoning for that at some point? And I think maybe you would be a person that thinks maybe this will be difficult to unwind at some point in the future.
Yes, it will be difficult to unwind. We have been winding for years and years. With every successive moment of crisis or difficulty, the central banks weigh in with lower rates, bigger balance sheets, and more intervention of all kinds. So what we see now is it's certainly unique, but it is if that's not a contradiction in terms, it's not unprecedented. There are precedents going back at least 25 years and arguably much longer. And, the chairman talks about the smooth functioning of markets, but the markets are not meant necessarily to be smooth. They are meant to discount future cash flows and to express the best guess of the collective group of investors as to the risk of default and impairment of credit. And what the central banks have done is to deaden those sensors. Junk bond spreads are back to were yesterday slightly back to below average for the past 10 or 20 years, I think, according to Marty Fritzen, which is astonishing given the state of things in the real world. So I would say that central banks have been instrumental in making markets less perceptive and to making them tell us less in the moment about how things really are.
I guess, Jim, in a real simple way to ask it is, when do you think either the stock market or the bond market will start to view the Fed and central bankers around the world as not part of the solution to all of our problems, but maybe adding to the problem and being part of the problem instead of the solution. We're not there yet, I don't think. Do you think we're really hearing accolades and praise for how the Fed has handled this? Do you think there comes a time where we look back, and you can even throw fiscal moves in on this too, as the debt soars, the national debt? Does there come a time, because we haven't seen a weak dollar necessarily, or a lot of inflation, or any of the things that hawks worry about, we haven't seen? Is that time coming?
I think it is coming. The muscle memory in the market is one of Fed dominance and helpfulness and competence. I mean, interest rates have been falling for, I guess in the fall, it will be 39 years. The Fed did not see the last crisis coming, but emerged from that trial with greater powers and greater prestige. So no, the market has not chosen yet to discount the Fed's abilities or judgment or capacities. But I think the moment of truth, we'll see it in a number of ways, or possible ways. One is if there is an unscripted rise in price inflation. Most everyone doubts that's possible. Certainly the existence of more than $10 trillion worth of securities worldwide priced to yield less than nothing, that's testament to a general conviction that price inflation is dead and decomposing. But, if you look at the rate of growth in various aggregates of the money supply over the past year, you're looking at 15-20% year over year and higher. Never higher rates of broad money growth in peacetime than at the present moment. The Fed's balance sheet has shown 80% or so year over year growth. If you annualize that, it's now 700%. The Atlanta, one of the Federal Reserve banks, I guess Cleveland, came out and said that come the next trial by fire, we might be looking at idealized negative federal funds rate of 14%. That's the analysts' conjecture on what would be the appropriate federal funds rate. So the Federal Reserve and the central banks generally have taken it upon themselves to intervene in a way that is just, to me, astounding. And what is equally marked is how well this has gone over with professional Wall Street. People, you wait, and I wait and hear someone say, isn't this the road to financial serfdom? The Fed's now talking about yield curve control. It's the handsiest federal regulatory agency I can think of. But we all collectively on Wall Street, we kind of take this in stride and say, that's the Fed doing what it can do and must do, and it's a humane organization. It wants to do well. But these interventions, these policy, radical policy begets more radical policy, which begets more leverage, more frailty, a greater propensity to intervene the next time, and right back in the soup. So whatever question you asked 5 minutes ago, Joe, that's the answer to it.
So if I were to be really on guard, if I was a sentry, what would be the canary in the coal mine in your view? What's the one thing that we would see if this was going to start unraveling in some way from Fed missteps?
Two things: gold and silver.
Gold and silver. 1,700. I mean, gold has finally challenged its old highs, but it's supposed to break through there. Supposed to break through 2,000 announced 10 years ago. Never happened.
Well, wait.
Okay. All right. Gold and silver. You gave me those two. I see it I see gold and silver advertised a lot on channels, and silver's been trending higher. Yeah, really? It's been trending higher for I don't know. Those commercials. It's the same commercial from 3 years ago. Is it still trending higher? Why isn't it going any higher? I thought it was trending higher. Anyway, it has a little. Anyway, Jim, thank you. We appreciate it.
You're welcome, Joe.
And I'm not trying to make, I love silver. I love gold. Anyway, Jim Graham, thank you. Andrew.
Okay, a lot more on Squawk Box ahead. Senator Ron Johnson on the reopening of the U.S. economy, the fear of a second wave and getting more money to small businesses. In the meantime, here are the futures at this hour. We are in the red. The Dow looking like it would open off about 722 points right about now. We'll talk about it on the backside of this, a big hour ahead.
I'm a crane operator by trade. It's kept me busy. It's provided for my family, and I've been running cranes this will make 34 years. I'm ready to retire. It's been since 2011 that I've really started getting into precious metals, moving money out of the stock market, trying to protect some of it. Makes more sense to me than a piece of paper. And it's an awesome feeling to hold that in your hand. I mean, it's been in monetary value for thousands of years, and it'll be here for 1,000 more. There's always a risk. I mean, you take a risk, put your money in the bank, you take a risk, putting it in the stock and bonds. I know I worked hard for it, and I know it'll be there tomorrow and the next day. Precious metals has given me the security in my life, knowing that my family's taken care of, knowing that my future is taken care of. What they've done for me in my portfolio is, I couldn't ask for anything better. I really couldn't. I'm well ahead. I'm very happy. My name's Dan, and I've been a customer with the U.S. Money Reserve for about 6.5, almost 7 years.
You know, there may never have been a better time to start diversifying your assets with physical gold and silver. And right now, it's easy to get started. Just pick up the phone and call U.S. Money Reserve.
If you've bought gold in the past or would like to learn more about why physical gold should be an important part of your portfolio, pick up the phone and call to receive the complete guide to buying gold, which will provide you important, never-seen-before facts and information you should know about making gold, silver, and platinum purchases.
With nearly 2 decades in business, over $1 billion in transactions, and more than 500,000 clients worldwide, U.S. Money Reserve is one of the most dependable gold distributors in America.
CNBC's Disruptor 50 list revealed. Innovation accelerated by a global pandemic.
These are the names and ideas shaping the new normal.
Special coverage on air and online begins Tuesday on Squawk Box.
Good morning. A big stock sell-off underway in the pre-market. Investors used to some big gains lately now showing their nerves after the Fed predicts a big economic contraction and COVID cases rise in some states. This hour, we've got breaking data on unemployment claims, then some exclusive numbers from Yelp on which businesses closed and who's reopening. Plus, we're going to talk about the big run-up in tech stocks and what comes next for the sector. Dan Niles joins us straight ahead. The final hour of Squawk Box begins right now.
Move apart. Good morning and welcome to Squawk Box. Here on CNBC. This we can do. I'm Joe Kernan, along with Becky. Oh, wow. Okay. I'm going to blush. Becky Quick and Andrew Ross Sorkin. U.S. equity futures at this hour indicated down more than 700 points. Now 720 points. Big losses in Boeing and ExxonMobil as we looked at financials. J.P. Morgan. Those losses in percentage terms, Dow futures have trended down for much of the morning. There you can see we're down 2% in the S&P, the Dow Jones down 2.7%, and the NASDAQ finally joining in on some of the pullback, which we did not see yesterday or the day before as the Dow fell. Treasury yields have backed down, I guess, under 0.7 now, 0.697, and then oil prices are also reflecting some of this weakness, risk off, whatever you want to call it, down almost 5%, down $1.94. Andrew.
Okay, thanks. Meantime, we have some news breaking on Moderna. I want to get over to Meg Terrell right now. She's got some of the latest details. Meg.
Hi, Andrew. The news coming fast and furious on vaccines and drugs for COVID. This morning, Moderna is finalizing the protocols for its planned phase 3 study of its COVID-19 vaccine, saying they plan to start the trial in July in the United States involving 30,000 patients. They'll be randomized with half of them on placebo, half receiving a dose of 100 micrograms. Now, that's toward the higher end of the doses they've been testing, but it's not the absolute highest dose that they tested in the phase 1 trial. The primary goal of this study is prevention of symptomatic COVID-19 disease. They'll also be evaluating whether the vaccine can can prevent hospitalization and prevent infection by the virus completely. At this dose level, they say they are on track to deliver 500 million doses per year, possibly up to 1 billion doses per year starting in 2021 with their manufacturing partner Lonza. They also updated on the enrollment in their phase 2 study, which just began a couple weeks ago. They plan to enroll 600 people. In the first 2 weeks of that trial, they enrolled half the study already. Those patients will be getting 2 doses of the vaccine 28 days apart, guys. So this moving along quite at a record pace here with this first phase 3 large-scale efficacy trial of a vaccine in the U.S. planned to start in July. Guys?
That's great news. Meg, thank you very much. We need to come to you about every 20 minutes just to keep up with what's happening on COVID these days. Thank you. We will see you again very soon, I'm sure. In the meantime, let's get back to the markets. This morning's implied losses coming after yesterday's gloomy outlook from the Federal Reserve. Fed officials said that they see the economy contracting by 6.5% this year, though they think it will grow by 5% next year and then 3.5% by the year after that. The central bank indicated that it will keep interest rates near zero for quite some time as the country recovers from the COVID-19 pandemic. Fed Chair Jerome Powell said that he's not even thinking about raising rates, but Powell also used last month's surprise jobs gain to point out that no one really knows what's coming for the economy.
If you look at the May employment report, it's a pretty good, probably the biggest data surprise that anybody can remember. It's a pretty good illustration of just how uncertain these times are.
The Fed also said that it will continue to increase its bond holdings, targeting Treasury purchases of $80 billion a month and mortgage-backed securities purchases at $40 billion a month. Joe?
Thanks. Back on the congressional side, with lawmakers debating more stimulus money, Wisconsin Senator Ron Johnson says any additional funding for small businesses should only be given to those that can demonstrate a need for it. For example, he says businesses could disclose what percentage of revenue that they've lost due to the pandemic. Senator Johnson joins us this morning. Do we still need to fine-tune the stimulus we already have, or do we need more, Senator?
Well, good morning. First of all, it's hard to say exactly how much we actually spent of the $2.9 trillion of financial relief, but it's probably somewhere around half, maybe less than half. So we probably have about $1.5 trillion that has not been spent, not been obligated. So before we start talking about authorizing more spending, we really ought to take a look at what we've done, what worked, what didn't work. And let's face it, we had to do something massive. We had to do something fast. I think, in hindsight, it by and large worked. We didn't see markets seize up. We had to provide liquidity. We had to provide that type of certainty. But now we, I think, can really take a look at what has not been spent, what has not been obligated, and let's sharpen our pencils and let's try and direct future financial aid to those workers, those businesses that truly need it, and particularly those businesses that really are viable, can reopen, might need more capital. We just need to be smarter about how we approach it moving into the future.
The dealing with COVID in terms of shutdowns and reopenings it's not even just statewide; it's almost county-wide, specific to what's happening. But could you just comment overall on what we're seeing, some of the troubling signs that we may be seeing in states that were not necessarily the original hot spots, but now seem to be moving into that arena, like Arizona or Texas? Is it troublesome, and does it mean that maybe the economy won't open as quickly as we had hoped?
Well, I was a pretty early advocate of trying to keep as much of our economy open as possible, recognizing so much of our economy is integrated. If you want to keep hospitals and grocery stores open, we need all the distribution systems open as well, and that every business, every organization is essential to somebody. But what we should have really focused on, again, I'm not being critical because policymakers from the president on down had to deal with some very imperfect information at the time. But now we've learned. But from my standpoint, what we should have been focusing on are the non-essential businesses that really pose a significant risk to out-of-control spread. Remember, the goal here was to flatten the curve so we wouldn't overwhelm our healthcare systems, and by and large, that hasn't happened. In fact, what's really happened is we've underwhelmed our healthcare systems. And it's important to recognize that an elective procedure for one person may be somebody's life-saving diagnostic or treatment. And so from my standpoint, we really should try and keep as much of our economy open as possible, open as much as we can, as safely as we can, recognizing the human toll of this economic devastation that we're undergoing right now.
Would you vote no against additional stimulus, Senator?
At this point, absolutely. Again, we haven't spent about half. About
for states, there's nothing that would make sense for you where it was something that's really in need, if it could be proven that's something that's needed? Too late?
Well, I would absolutely vote to redirect, repurpose, remedy part of the $2.9 trillion. But right now, we do not need to authorize more spending. That's probably the last thing we need to do. But we do need to take a look at what we've already done. Again, not being critical of it. We had to do something massive. I think by and large that worked. But now we need to focus and really direct what we're going to do in the future based on what we're dealing with right now. One of the biggest problems with the relief packages we passed, we wanted to help workers. No doubt about it. Everybody wanted to do that. But the $600 flat payment, plus up of state unemployment, Wall Street Journal ran an article, 68% of people currently on unemployment are making more on unemployment than they made in their job. That is a huge disincentive to return to the workforce. And I hear from employers all the time they can't hire people. They can't bring them back. We have incredibly high levels of unemployment. There's still jobs open that are going unfilled. So anything we do, we need to make sure that we provide incentives for people to come back in the workforce and the capital for businesses to reopen.
Just switching gears entirely, do you foresee a federal answer or solution to what we've been witnessing in terms of police reform or some way of just trying to make some progress on these intractable issues that the country has faced for so many years?
I think there's a real sincere effort, probably on a bipartisan basis, but I know certainly within the Republican conference, to take a look at what the federal government can do. I think we're well aware of the fact that policing is by and large a state and local issue. And I think you need to be a little careful in terms of the federal government imposing its wishes on state and local governments. But I don't know anybody that didn't take a look at what happened to George Floyd and not just recoil at the horror of that, and just take a look at other instances, things that possibly can be done in terms of training and data gathering to provide better information. Take a look at the police unions in terms of some of the protections they offer to bad cops. But I really do believe the vast majority of police officers are good people. They're doing a very difficult job. They're putting their lives on the line. A lot of them lose their lives, so I completely respect the position they're in. And I do believe that the thing that good cops hate most are bad cops. But we need to have a system to be able to weed those folks out, that very small percentage that really should be weeded out of the profession.
All right, Senator. Thank you for all the different topics we went over. Appreciate it this morning, Senator Ron Johnson. Thanks. Ron John.
Okay.
It's a surf shop, I think.
A lot more on Squawk Box ahead. Futures pointing to a pullback this morning. We are in the red. We're going to get a progress check on reopening the economy. You're looking at the Dow off about 700, close to 750 points right now. Meantime, the CEO of Arkansas-based Southern Bancorp is going to join us. They've handed out PPP loans ranging from just $200 to nearly $5 million. We're going to talk to Darren Williams right after the break. And as we on CNBC.
In a changing environment, consistency keeps us on track. Columbia Threadneedle Investments.
Why bother mastering something? Because when you want to create an entirely new feeling, the difference between excellence and mastery is all the difference in the world. The Lexus ES, a product of mastery. Experience amazing at your Lexus dealer.
Squawk Alley examines the pandemic impact on business risks, tech advances.
You are seeing it play out in those space names that are publicly traded.
Squawk Alley, 11 Eastern today. Watch and listen live on the CNBC app.
Getting out of bed is, let's face it, kind of terrible.
And at Bull & Branch, we don't make it any easier. Our 100% organic cotton sheets are so incredibly soft, your bed becomes your happy place. When you're cozied up in beautifully made, stunningly soft sheets, there's no place you'd rather be. So, yeah, we don't make mornings any easier. But we do make them better. Try getting out of Bull & Branch sheets risk-free for 30 mornings.
Prescription eyewear can be really expensive, but here's a secret. Glasses don't actually cost that much to make. Surprise! Especially when you design your own eyewear and then sell it directly to your customers. Like we do. Oh hi, we're Warby Parker. Our glasses start at $95, including prescription lenses. And the best part? You can try 5 pairs for free at warbyparker.com.
Welcome back to Squawk Box this morning. The futures are in the red, continue to give back some of the gains from this past week. You're looking at the Dow off a little over 750 points, now about 766 points. S&P 500 looking to open down about 73 points. The NASDAQ looking to sell off about 154 points. Some of this may be just taking profits. Much of this may also be what the Fed said yesterday about their expectations for the economy. Meantime, I want to check out some shares of some of the biggest U.S. banks in the pre-market as well, show you where they stand. We're looking right now at a screen of red across the board. Wells Fargo down the most, off about 7, almost 8.
The station you're listening to is experiencing technical difficulties.
We have 8% there. You're looking at Citi, Bank of America, all taking hits as well. Right now, I want to get a broader look at the banking sector and progress on reopening the economy. Joining us right now is Darren Williams. He's the CEO of Southern Bank Corp, which has provided more than 1,200 paycheck protection loans to rural, low, and middle-income communities. Darren, I want to thank you for joining us. There's so much to talk about. I want to go though straight to the news this morning, given the sell-offs in the market and really the expectations of the Fed for the next 12 months, if not longer. What are you seeing as the CEO of one of the largest banks in your region?
Well, we see a community or a business community that's really still a little concerned. If we can reopen the economy, given this pandemic, if consumers have confidence, then we think our borrowers, our customers will be fine. We provided various forms of payment relief during this uncertain times. So we're optimistic, cautiously optimistic, but if we can regain consumer confidence, if the communities, the markets we serve can open back up safely, then I think we'll be in good shape.
You heard what Jay Powell had to say yesterday in terms of their expectations for what employment looks like in this country over the next 12 months. What's your expectation for employment in your region?
Well, understand we serve the Arkansas-Mississippi Delta, and this is one of the most persistently poor communities of all the United States. And so when other markets were flourishing, we're thriving much better than we are. So we've always had a low unemployment. And so we're obviously concerned about that. That's an issue for us. So we're going to continue to monitor that and continue to watch that. But we want to do all we can to support the small businesses that provide the jobs in the markets that we serve.
Well, let me ask you about that specifically. We just had Ron Johnson on this last segment, and Joe asked him about whether we need more stimulus money, whether we need to get more money to small businesses. What's your view on that?
Yeah, I think so. So, the Paycheck Protection Program was a big help for the markets that we serve. Many of our business owners said it was a lifeline. It allowed them to keep their employees working. We provided over almost 1,100 and 1,250 paycheck protection loans for over $111 million, and that was very much needed. But the Paycheck Protection Program was very limited in how those dollars could be spent. Most of that had to be spent on payroll. There are other things that businesses need to support themselves to allow them to survive this pandemic. So there may be a need for additional support to small businesses that are really the backbone of this economy, that really who are creating jobs. Until consumer confidence comes back, until we feel safe about going back into the market, going back into restaurants, going back into stores, these businesses probably will need additional support.
There are some economists that are worried about what happens to employment come the end of this month, given that some of these loans and the provisions around employment. You were just discussing how you think these loans are being used. Do you think there are people that are being kept on the payroll that may not be on the payroll come July?
It's quite possible. Again, if consumer confidence doesn't come back and people don't return to the stores, to buying, to purchasing, many of these businesses may not need as many of the people as they have now. And so, sure, we're concerned about that. The Paycheck Protection Program really required, initially it's 75%, now that's been reduced to about 60% of those dollars had to be spent on keeping people on the payroll. That was a primary driver for that money. And so there are people who may be on the payroll where businesses may not need them right now. So that is a concern.
What's loan growth look like for you guys right now?
Well, I must say, loan growth it's not nearly as high as we would have expected, but prior to the pandemic, we are seeing loan growth. We have a pretty diverse loan portfolio. We operate in some pretty rural markets, so we serve folks in the agriculture industry, so our farmers are still planting, and so we have some loan growth, but the vast majority of our loan growth, unfortunately, has been from the Paycheck Protection Program. So loan growth, while it's slowed, it's not completely diminished, but we would love to see it increase even more.
And what are you seeing in terms of delinquencies?
Again, we provided as much relief as we could, both to our consumer and to our business borrowers. And so we provided a 90-day payment holiday for any consumer for any reason without any fees. And on a case-by-case basis, we work with our business borrowers to provide them relief. So right now, we're not seeing delinquencies because we've given people as much as 90 days of payment relief or interest-only payments. We are watching very closely, analyzing very closely. Right now, our asset quality remains strong. But, we'll see that in the third, fourth, first, second quarter of next year. So we're going to continue to monitor that. So far, so good, but we're cautiously optimistic.
As you're speaking, we're looking at the market, pre-market, and as I mentioned, it's off now over 800 points. Do you see a disconnect between the market right now and the economy as you're seeing it as a CEO?
Well, there's a disconnect, particularly in the markets. Particularly in the markets we serve. We serve, again, some of the most persistently poor communities of all the United States in the Arkansas, Mississippi Delta. Very, very low income markets. And so there appears to be some disconnect. But again, our markets, our communities are resilient. We believe that we can bounce back. And we're going to do all we can to support our borrowers and our customers through this economic crisis.
Darren, let me ask you this. The country, as you know so very well, is reeling after the murder that took place now 2 weeks ago. And we've been having some really, I hope, important and powerful conversations on this network and elsewhere about what needs to happen in this country to change the dynamic, to really end the systemic racism. And you guys are doing a lot where you are to try to get money into people's hands and trying to figure out what the private sector can do. What do you think can be done immediately?
Well, immediately, we've got to continue to have these difficult conversations. I'm pleased to see that so many people are speaking out, speaking against the type of injustices that we've seen, that people of color have known for some time now. I'm glad that people are becoming woke. They're understanding what's happening, and they're speaking out against it. But speaking out is not enough. We must act. We must take action. Every industry must look at itself. Every company within that industry look at itself and see what's been their role in the systematic and structural racism that's caused the problems that we're seeing throughout the lives of people of color, not just in the criminal justice system, not just in police brutality, but in almost every facet, in healthcare, and access to financial services, and education. Everyone's got to look at their own company, their own industries. And the banking industry, for example, redlining was outlawed in 1968. But even today, people of color have much harder time accessing mortgage loans. People of color, business owners are denied business loan at 3 times the rate of whites. Our businesses, our banks, we've got to look at what are the structural reasons for this. We've got to be very intentional about this. We've got to intentionally create programs and products that serve this community, that help to build these communities and help solve this wealth gap that we see. And that'll go a long way in tearing down these structures, these systems that have allowed for the basic racism that we see today.
Darren, I want to thank you for joining us. I hope you come on back. It's a longer conversation, and we appreciate you being with us this morning and offering your perspective on all of it. Thank you so very, very much. You bet. Joe?
Thanks, Andrew. Coming up, breaking data on unemployment claims. It's Thursday. Guess that is due today. Estimates still calling for a number well above 1 million for the last week, almost 1.6 million. Then we're going to bring you a special look at some on-the-ground local business data from Yelp, helping us with the question, who closed and who's reopening? The futures right now are at the worst levels that we've seen. Closed, almost 900 now. Stay tuned on the Dow. Stay tuned. You're watching Squawk Box on CNBC.
Our retirement plan with Voya gives us confidence.
Yeah, they help us with achievable steps along the way, so we can spend a bit now, knowing we're prepared for the future. Oh,
Surprise!
We renovated the guest room so you can live with us.
Oh, well, I'm good at my condo.
Oh.
I love her condo.
Nana throws the best parties. Well planned, well invested, well protected.
Voya. Be confident to and through retirement.
Here's my definition of fiduciary. It's more than just acting in the best interest of our clients. It's being responsible, proactive, involved in every aspect of our clients' financial well-being, making sure every investment and every interaction is suited to your needs. We serve you. We look out for you. We care for you.
Charles Schwab is proud to support the independent financial advisors who are passionately dedicated to helping people achieve their financial goals.
Struggling with debt? Ask for help. Talk to your lenders and creditors about COVID-19 relief programs. You may be able to delay monthly payments on federally insured mortgages for up to 1 year. Stop federal student loan payments until September 30th and pay no interest. And extend or delay payments on credit cards and auto loans. Just be sure to ask your lenders and creditors about interest and how much it'll add up.
Welcome back to Squawk Box this morning. Take a look at futures because as the morning has progressed, we've seen more red. The Dow looks like it would open down about 850 points right now. NASDAQ off about 176 points. S&P 500 off about 81 points. It appears in large part based on some of the comments that had come out of the Fed and Jay Powell's expectations about where the economy may or may not be in unemployment throughout the rest of this year. It may also be investors taking profits. Big questions, though, about where things are headed. Becky?
Andrew, in the meantime, let's take a look at shares of Grubhub. The company has agreed to be acquired by European food delivery system JustEatTakeaway.com in a $7.3 billion all-stock deal. That transaction would create the world's largest food delivery system outside of China. The agreement comes after acquisition talks between Grubhub and Uber fell apart. It raises all kinds of questions about what Uber does next. When we looked at that stock earlier, it was indicated down. You can see Grubhub shares up by over 7%, and JustEatTakeaway.com shares are flat. When we come back, some breaking economic data due out in just minutes. We've got the latest initial jobless claims figures that are expected to top 1 million once again as the virus keeps battering American businesses. Those numbers are next. You are looking at the Dow futures indicated down by almost 840 points. Things are heating up here. We've been down all morning long, but these are about the weakest levels we've seen. S&P futures down by 80. The NASDAQ off by 171. You are watching Squawk Box on CNBC, and we'll be right back.
It started in 1898, helping clients and communities invest in hospitals and schools, roads and bridges, farmland and forests, small and large businesses, and sustainable cities around the globe. It continues today, more than 120 years later, investing to make an enduring impact on our world.
I lost my job. My wife was furloughed.
I had to lay off
about 3,000 employees today.
I have to homeschool 3 kids while working full-time.
My HR department is flooded with requests for mental health resources.
We're all affected by this crisis, but we're resilient. Sherman's working with CEOs, policymakers, HR professionals, and workers across the globe to navigate these times. I'm Johnny C. Taylor Jr., President and CEO of Sherman. Together, we will create what the new future of work looks like.
Ever since we've gone mobile on the Now platform, something's gotten into the office.
I hear you. Feels like there's no barriers between departments now.
Think everyone appreciates it?
I do.
Huh. Forgot my glasses.
ServiceNow, the smarter way to workflow.
The rollback barometer. States on the mend. Facing nationwide unrest. Progress reports for a COVID cure. And rough times for commercial real estate. Stay connected. Stay informed. Watch or listen live on the CNBC app.
Hey, did you?
Yep, done.
And
Of course.
And?
Oh, yeah.
All in 1
hour.
Behind the world's most productive people is the world's most comfortable chair, the incredible X Chair, featuring patented dynamic variable lumbar support. X Chair's adjustable seat depth keeps users small to tall, comfortable and supported. Available in breathable mesh, HDR foam, or top grain leather. Customize comfortable positions for your neck and arms. And X Chair's patented SideFloat Infinite Recline provides the perfect recline for users of almost any size. This is not your grandfather's office chair. X Chair supports workers everywhere who find themselves now working from home. Call or click to get $100 off the amazing X Chair featuring dynamic variable lumbar support. Plus, for a limited time, you can also get free same-day shipping. This deal is good for any X Chair you choose. Create the world's most comfortable home office with X Chair. Call or click to order today and receive a 30-day risk-free trial and $100 off.
Welcome back to Squawk Box on CNBC. We're just seconds away from the latest initial jobless claims numbers and producer price data. It could affect what we're seeing in the markets. Down 800 plus points on the Dow. Rick Santelli has those numbers at the CME. Rick.
Well, will we be looking for a 10th week in a row on claims being lower? It hasn't hit the wires yet, but that's what the numbers are deemed to be. And indeed, it's a definite yes on that. Last month, of course, or last week, I should say, was 1.877 million. So it was subtly not revised. I'm sorry. That's exactly the way it stood. This week, 1.542 million. 1.542 million on this week on initial claims, and on continuing claims, 20.929 million. 20.929 million. And if we look at that particular number, that follows an unrevised also 21.487 million. So definitely it is a bit lower. And if we continue to look at the drops in these numbers, maybe we'll actually get some positive comments from our Fed chairman at the next meeting. If we look at PPI for the month of May, up 0.4, up 0.4. That is definitely a bit of a surprise. And on core ex-food energy, it's down 0.1. And if we look at the rear view mirror, minus 1.3, of course, that was a big number. And you only have to go back to 2009, Joe, on PPI, because in the last crisis, they modified it a bit. They just wanted to have inflation be more, moldable in a way that they could control it. And that number is the worst it's ever been since 2009, core at minus 0.1. And there are some revisions now coming out to continuing claims, by the way. So it now stands on initial at 1.897. There was a bit of a delay there, so it moved actually a bit higher. And on continuing claims, it also is revised to 21.268 million. So that's a bit of a drop considering the last numbers. Of course, this week's numbers are lower. Now let's go to year over year on PPI, shall we? Year over year, minus 0.8. Year over year core, up 0.3. So this data is pretty much a surprise on the upside, what's going to fall here. But indeed, we do see a divergence in many prices with regard to energy and food and some of the things we buy on a continual basis. And I am sure that as we reopen parts of the country, we will see more anomalies like that on pricing.
Okay. Rick, stay around. We're going to talk a lot more about the markets in just a moment, but Steve Leisman joins us right now, too, and we want to get his reaction to these numbers that we've just seen. Steve, go ahead. What's your reaction?
Yeah, there was a big jump in food prices. I saw a 6% jump, Becky. I'm sorry, trying to learn to read these tables in real time. We used to get them from the wires, but there's no more lockup out there, so we're just dealing with it in real time. And I'm looking at these energy numbers here. I thought I saw an energy increase, which I can't quite square with what's going on. Final demand for 4.5% energy prices in the PPI. I don't know where that's coming from. There was a turnaround, as you know, in gasoline and oil prices, and it must be picking up that, even though while they're low, they're very high. Back to claims, it's a debate, I think, within the market between the change, which Rick emphasized, and the level. Yes, it is down for 10 weeks, but it's still 1.5 million. It's still an enormous number of people are losing their jobs and filing for jobless claims. So, look, we have to square up the idea that everybody thought the jobless claims number was a good way to forecast what was going to happen in the payroll number. That's no longer thought to be true. We have to think about what the right way to think about it is. But what we know for sure is that there's still a lot of people filing for jobless claims. It could be that it's catch-up. It could be some mandates that people refile every 2 weeks. But bottom line is there's still a lot of pain in the job market. And while the numbers are going down, look, I think it was 600,000 was the most you ever saw in a single week during the great financial crisis. You're still at multiples of that. So you can focus on the change, and maybe that makes you upbeat, or you can focus on the level, and you still see an awful lot of work ahead and still deterioration in the jobs market.
We have been watching the futures all morning long, and things have definitely taken a turn for the worse. When we started this morning at 6 a.m., we were looking at the futures, the Dow down by 460 points. Now you're talking about the Dow down by more than 900 points. S&P futures are off by 86. The NASDAQ is down by 185. Again, this is a progression. At this point, the Dow futures indicated down by about 3.4%. That's the type of move that really starts to catch your attention. So let's talk some more about this morning's sell-off. We've got a couple other guests joining us right now. Mike Santoli is here, also Jim Uriel, who've been watching this very closely. Mike, let's talk a little bit about what you've seen this morning. What's happening?
First of all, Becky, the setup was the market was a little bit stretched. Even when we're opening at these levels of the S&P 500, you're basically going back to the beginning of last week. So that last little push higher, and this is in hindsight. We were talking about how the market looked a little bit overheated and stretched, and some of the sentiment and tactical indicators were getting a little bit extreme, and we're seeing a little bit of a rollback of that. Now, I do think there's often on the day after the Fed meeting, mentioned this yesterday, sometimes a bit of a rethink. The bond market clearly is rallying, therefore yields getting compressed. Just a reminder that, in fact, we're in perhaps for a long slog here. So it's a little bit of a gut check on this idea that we had this runway toward momentum of a reopening, and it was just going to be relatively smooth and strong. And I think we're just having a little bit of a check on that enthusiasm at the moment. It's not necessarily anything that has, at this point, certainly gotten beyond the level of a routine pullback. But this has been a pretty fast-moving market, so you have to stay on top of it.
Jim, let's talk a little bit about WTI, too. We've been watching this morning, and last I saw, WTI was down by 7%. So energy has been incredibly volatile with all of this, too. I don't know which one you think is leading which. Is WTI leading the market leading WTI? Is all of it being led by the Fed's comments?
I think all of it's being led by the Fed's comments. First, to answer the question about the market, starting on March 23rd, when we started this rally, that was the day that the Fed said unlimited QE. So regardless of what camp you're in as to why the stock market is rallying, whether it be that it's forward-looking or whether it be that it's Fed liquidity, you can't deny that at least part of it is Fed liquidity. So all of this is that it's building up to yesterday, where we want to hear from the Fed and we want to hear that they're supporting the market. And that's what the rally was up into it. So it's a buy the rumor, sell the fact kind of thing too. Now, secondly, I think that news coming out of Texas, Arizona, and Florida, and people haven't dug into this news yet, but I think people are now a little bit worried that a second wave is upon us, and that is more of an excuse to sell it than any real hard data. But as far as the oil thing goes, just the negative 40 print up to the positive 40 print in futures contracts over a month just shows how wildly volatile that it is. And yes, negative 40. This is price discovery, I guess, in its most ugly fashion. So 40 seemed like too high, and I think that there's still a global recession / depression going on, and even $1 at 96 is not going to help that quite yet.
Hey, so Santoli, I know what Powell said yesterday and all that, but I immediately thought it had more to do with worries about some of these state spiking. Yeah. But then, and I looked at the airline stocks, some of the hardest hit, Boeing, the biggest loss leader in the Dow. It seems related to all the COVID cases, but then I realized that's also where the biggest gains have been. That's right. The most outsized gains. So I don't know whether it's just that those got extended and that's why they're coming back, or whether it really is concerns that we're not out of the woods yet.
I think it's all of the above. I think the fact that people felt as if the market was benefiting from the fact that if you were really worried about complications to the reopening or switchbacks in some of these policies that were not going to be as good for the economy, you had weeks and weeks before that was ever going to come into play. I think the data on Texas and Arizona, it's been bubbling in this direction for days, and the market was ready to look at it at this point on the day. Hey, by the way, the NASDAQ closed at 10,000 for the first time. Tesla closes at 1,000 for the first time. People were feeling pretty good, maybe a little bit too good, and I think it's normal oscillations in the market. It's the normal kind of mood swings that animate stock prices, and I absolutely, this is a legitimate excuse, as Jim says, to have a little bit of a rethink, but not necessarily a lasting change in trend.
Well, we'll see. Yeah. Depending, right? There's a lot of people out and about, and we've said that. I mean, people shoulder to shoulder all over the place. So, I mean, that might not. We've heard this is a first wave in Arizona and Texas. It's not a second wave.
Right.
If we really do get some kind of second wave on the East Coast or something, then all bets are off, I would say, wouldn't you?
Well, and it also speaks to this other big question that's been hovering over the market is we're seeing these massive comebacks in things like air travel and mobility, but what equilibrium does it find below the former peak? Right? Where are we actually working toward in this improvement? And that's, the fears about possible rises in infection is something that's
a form of lockdown. And if these news stories start to affect the decision makers, whether it's really happening or it's not really happening, those lockdowns stay longer. And, a very, very clear economic fact. We're living that right now in Illinois. And the people, like you see the restaurants that are open outside, in mine particularly, people are absolutely flocking out. It seems like they're not ready to go on any sort of extended sort of lockdown. But I think the worry is that these guys
Santelli stick around too? Yeah. Hey, is Rick still there?
Yes, I'm here.
The 10-year was actually above 0.9% earlier this week. Now you're looking at it back below 0.7%. So these swings that we're seeing in equity prices also playing out in bond prices and yields too. What does that mean to you?
Well, it means to me is that the market is got this cycle going into employment reports, which most likely will continue to improve on the jobs front just due to the math and rate of change. As we led into that, on Wednesday before the jobs number, we topped 70 in the 10-year. On Thursday, we topped 75 basis points. On jobs Friday, we had an intraday high of 95. We settled a whisker below 90, and we haven't seen 90 since because the Fed meeting's coming up. It's a diametrically opposed lead-in. Leading into the jobs report every first Friday of the month, you're going to see equities firm, you're going to see rates go up. Going into Fed meetings, most likely you're going to see the exact opposite. And I think that this is going to be around for a while. There is a tug of war going on within the market based on information that everybody is just guessing about. But the one thing we're not guessing about is the T in trillions that Jay Powell and the Treasury have jointly agreed to throw into the economy. And I don't know how we can forget that and scratch our heads and wonder how all of this has occurred, because that is at the epicenter. Jay Powell, in many ways, bought and paid for the rally.
Okay. It's a fair point. It's a fair point. It's been a huge criticism that's been around for quite a while. Jim?
Yeah, no, there's no question about that, too. And another thing as well is that us being disappointed about Jay Powell yesterday because we wanted to hear something about curve control. We wanted to hear him say that he was going to compress the long end. He gave us curve control. He said he doesn't think we're going to raise rates until 2022, which, by the way, I think Jay Powell makes a decision, puts that out there based on what he thinks the market and the economic condition need right now. I don't think him saying that means he really believes that. But the point is that is curve control. If he's going to control the next year and a half of the yield curve, yes, the implication is there that he's perfectly willing to start extending that out further and control the curve out to however. So, yeah, of course, this part of the rally has been a Jay Powell fueled rally. And for the second part, and we're talking about all-time highs here, by the way, to go through all-time highs, I don't think it's unreasonable to request some genuine, meaty economic data that supports it. And that's probably still months away. So this, to me, seems like a fairly normal breakdown in the stock market. How long it goes, I personally think just a couple more % from here.
Hey, Mike, how much of this is potentially professionals taking advantage of retail investors stepping back in? We were talking yesterday with one of our guests about how he thought there was something, a massive amount of money on the sidelines from retail investors who had now felt like they had missed out on this run back up. Andrew said he had talked to some hedge fund managers yesterday saying that they were able to make good and finally get out when they recouped their losses that they'd been sitting on all year.
Well, I certainly do think, Becky, in a lot of the the real speculative names, the kind of story stocks, the so-called lottery tickets that people were paying more than face value for, like the bankruptcy names, that is pretty easy to take the other side of that. I don't think overall in the market, I mean, Apple made a new high yesterday. I don't necessarily think that was because small traders buying fractional shares of Apple were taking it higher. Is because that's what the market does when it's feeling more defensive. It buys these monstrous bond proxy type stocks like Apple and Microsoft. So I don't know that it was really a factor in the overall indexes stretching to that high and then professionals selling the peak. But the retail giddiness that we saw in pockets
to go.
They never got that far, I don't think. Though,
they didn't go forward. They didn't go forward and they were flying around. So Elon Musk has got to get on the stick because we're not obviously doing that yet. Anyway, I digress. Becky.
I just want to thank everybody. But Joe, I never thought of that. What if you went back to 1919 and brought the Spanish flu forward? You can't do time travel because you don't know what you're going to do, what you're going to mess with.
You don't want to do anything in the past. If a butterfly's wings do something that, everything, we wouldn't even be born probably or something. I don't know. It's very scary to mess with the past. And supposedly there are alternate universes going the other way. So never mind. We'll talk about that some other time.
In this universe, the Dow is down by 889 points. We will continue to watch this story very closely.
Coming up, more on the markets as we make our taking on the chin down 185. The biggest pre-market decliners in the S&P 500. You can see airlines, oil, energy-related issues, and a cruise ship. Take a look at some of the top stocks in the retail sector getting hit once again. Stay tuned. You're watching Squawk Box on CNBC.
We hope you find these digital solutions helpful to bank from almost anywhere. Deposit a check with your phone or tablet. Check balances, pay bills, and more. Send money to people you know and trust with Zelle. Explore all you can do with our digital tools from almost anywhere. PNC Bank.
Hey, Lily from AT&T here. I'm back, and while most stores are open, I'm working from home and here to help. Here's a tip. Get half off the amazing iPhone 11 on AT&T, America's fastest network for iPhones. Second tip, you can put googly eyes on your stuff to keep yourself company. For example, that's Geraldo. He's my best friend. Oh, sorry, Nancy, I forgot you were there.
Get the amazing iPhone 11 for half off on AT&T, America's fastest network for iPhones.